Hello guys, it's Chris from TheTradingExchange.co.uk, and this is the second video in our series for the training course, and we're going to be taking a look today at the MACD. Now this video is going to specifically benefit anybody who's looking to either make more money on their trading, get a better understanding of how to use MACD in their trading, or just really understand how it all works and get a simple strategy that they can use. It's designed for people who are spread betting or CFD trading, and it can work on Forex, indices or commodities. And because we're going to be taking a look at that, I've got a disclaimer I need to mention, which is that trading financial markets is risky. It involves the risk of losing all of our invested money. So please use any of the information at your own risk. It's really for educational purposes only, and we're not providing any financial advice. Okay. So let's bring up a chart. In front of me here, I have a chart of the German DAX, which has fallen like a stone. It's the last 6 months or so's worth of data. And underneath that, we've got a MACD indicator that's been preloaded. So for anybody who's using FXCM's market scope, if you've created an account through us, through our link to support the site, then you'll be following a similar instruction. So once you've got a chart up in front of you here, you press the I on your keyboard. That'll bring up your indicator dialog box. In the search, you can type the 4 letters MACD, and you can then double click on the recent, you can double click on this classic oscillator. So the dialog box for this particular indicator says it's a trend following momentum indicator that shows the relationship between two moving averages of prices. The dialog box that you'll have for the settings of MACD might look like there's a lot there, but really it's just these three numbers. The default 12, 26 and 9 is often used, so I would just leave that as it is and press OK. There you go. Okay, then, so let's get started. So MACD is the shortened name for moving average convergence divergence, and it's a commonly used technical indicator. The indicator is derived from a combination of exponential moving averages, which we touched on in the previous video, so go and check that out if you've not seen that already. And these exponential moving averages, or EMAs as we'll refer to them, can help a trader identify potential trading opportunities. So MACD can be used on any market, on any time frame, and it will appear on all of the charting packages as standard. So if you're not using FXCM, or you're using MetaTrader or NinjaTrader or whatever it is, you'll find MACD on there as well for free. Okay then, so MACD is a technical indicator as we've discussed, and more specifically it's an oscillator. So it ranges between normally 100, or 0 and 100, often with a lot of indicators and oscillators. But MACD actually can range, in this particular case, plus or minus 100,000, or let's say 2,500 in this case, and it would oscillate around a 0 line or a center line. Now, to get the most out of an oscillator, it's always worth identifying whether the selected market that you wish to trade is trending or ranging, because in my opinion, these indicators will work better in trending markets. So for me, rule number 1 has to just be to get into the habit of identifying this every time you look at a chart. What direction is the market heading? So this is a 6-month chart of the German DAX. If you gave that to a 6-year-old child and say, what direction do you think that's heading? They'll probably tell you it's heading down. Yeah? So you want to find out, is it up, down, sideways, which way is it moving? Moving averages can help you with that, but get into the habit of identifying your trend. Okay, so in technical analysis, one of the most frequently used concepts, specifically with MACD trading, is what's called the MACD crossover. Okay, that's where the two different lines are going to cross over each other. And these will create signals. And you can easily trade moving averages on your own, on a chart. So for example, let me just show you, if I apply two moving averages to this, two EMAs, one's going to be a 200-day EMA, and one's going to be a 20-day EMA. Okay, you can see them on the chart there. There we go. In true Blue Peter fashion, let's just bring this chart up here. Here's one I prepared earlier. So you can easily trade moving averages on your own. So for example, looking at this 200-day moving average and 20-day moving average on the German DAX chart, you can easily see an entry and an exit here. Okay, so you've got this point A. Just for the moment, ignore this, but that's point B, and this will be point C. So on the crossing of a moving average, you could perhaps have got in at a trade here, and then when it crossed back the other way, you would have got out there. Made quite a nice trade, but you can see an obvious problem here with the technical indicators, specifically moving averages, because they're lagging indicators. So it kind of shows what's already happened, and it struggles to keep up with current market conditions. And so the creator of MACD, Gerald Apelli, I think his name was, recognized this, and he wanted a signal that would allow him to get out at point B or nearer to point B. And he discovered that by measuring the distances between these two moving averages, you could get an exit that would be better when the averages started to cross together or started to close together again. And that's how MACD was basically born. So if we keep in mind that the premise of MACD is very much just based on having two different moving averages, the distance between those two moving averages is pretty much what it measures. And you keep in mind that you want to make sure you're trending or trading in the direction of a trend, you can start to form a simple strategy once you've got the hang of it. Now, I know I've talked about this before and I might be labouring on this point, but trade in the direction of the trend. There are some traders that disagree with this, and there are some traders that will operate a counter-trend strategy, so it goes in the opposite direction of the trend. They don't want to follow the trend, they want to go the opposite way. And that's up to them, that's fine, but we're not going to be talking about that within the scope of these videos or this article. Okay, so we're laboured on that point long enough. Let's move on. Now, the MACD, to a complete novice, can appear quite complex. There are various parts to the indicator, as you can see. There's this kind of central line, the zero line. There's the histogram, which is oscillating around the centre line. And then you've got these two moving averages. And the histogram is the histogram. But these two moving averages are quite important because one of them is the MACD line and one of them is the MACD signal line. And you'll get a signal to trade when you find that the MACD line crosses either above or below the signal line. So in this case, the MACD line is red for me and the signal line is blue. Might be different on yours, but hopefully it should explain to you which one's which. And this crossing of the two lines can signal a changing in momentum. And that's what traders are often looking for to identify some key trading opportunities. Now, more advanced usage of this indicator would be to combine it with support and resistance. So you're looking for particular areas where price has failed to pass a particular area before. So, you know, this market is trending down. So we're looking for areas where price has gone up to resistance and then changed. And resistance is obviously a point where price has struggled in the past. That's my simplest form of calling it. So I've just marked out 3 points, there, there, and there, using a horizontal line. So we're looking for points where at these lines price would have turned. And there's an example here, for example, where this red MACD line crossed below the blue signal line. There's another opportunity here. There was one here. And there's another one right there. So they're signaling the opportunities to sell the market. There are other ways you can use the indicator to get those signals, but that's the simplest one. Okay then, so let's just say you found your trending market, okay, and the trending market is one that's going up. Okay, so you want to buy the market because it's going up. Let's take a little look and see if we can find an example of that. Okay. Here's one I prepared earlier. This is a simple picture of the dollar CAD, and as you can see, it was from 2016, from around about January time. I don't think this is a daily chart. I would imagine this is probably a 30-minute chart, just from guessing. But you'll notice that there were some crossovers. We know that we want to be trading as the market's going up. There were some crossovers of the red signal line. You can just about see it crossing above the signal line. Here, 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 here. 4 different signals that you could have used to trade that. Now there's no support or resistance lines marked out on this. It's just simple crossovers only in an uptrending market. But had you have taken those trades, if you'd have taken all of them, in fact you could have even done this one here, but that was the very first trend line that we've used. So we ignore that. 4 opportunities to get in and trade that. If you could even say that was a 5th perhaps, but it's not in view. To get in to that trade, so quite profitable if you'd have held on to that. Good few hundred pips. Okay. How about the other way? Let's take a look and see if we've got a downtrending market. Let's see if I can do another Blue Peter. There it is. Here's one I prepared earlier again. And this is the German DAX once more. And got a pitchfork here, but let's ignore that for the moment. It's just for utilizing potential resistance. But you've got 4 different points marked out here that would provide some selling signals. As the MACD line crosses below the signal line, 4 different times you could have gotten in and traded that and made some decent points. So that just highlights the simplicity of using them for signals. Hopefully that makes a bit of sense. Okay. So you go again through the sort of the last few days or hours or weeks of data on the chart. Mark out some support or resistance lines if you're familiar to do that. And once you have done that, you wait for opportunities where the price has rallied up to either a point of resistance, if you're looking to sell, and the MACD indicator provides your selling signal. Okay, and it works the other way. So if you want to buy, you wait for price to sell to a point of support, and then when you get that crossover signal, you buy. It's really nice and simple if you keep it that way. So buy during opportunities after price pulls back to support, sell during opportunities where price rallies to resistance. And a lot of newer traders don't follow that guide. Maybe they're impatient or whatever, and follow the indicator blindly. So, 90% of traders fail for a particular reason, and that's often because they follow indicators and statistics or signals blindly. Don't be another failure statistic. Simple example of that. Don't want to labour again on this point, but we know that this market was trending down, so we're not looking to buy. So if you bought, for example, you might find that you're buying at the top of a spike, and you just get yourself into trouble. So if you'd have bought here, okay, you'd have made a couple of points, quite a few points perhaps, because it's a daily chart, but really you're looking for the bigger moves down. You could have been held in that trade for a while in a losing position. You don't want to be buying in a falling market. Okay, so MACD settings then. Let's take a look at those. So once a trend's been identified and you've got your support and resistance, as we've talked about, we're looking for signals on the MACD indicator. And the MACD line crossing the signal line indicates a buying or a selling opportunity, so we know that. But of course only if the trend supports that. So the typical default details for the MACD are 12, 26 and 9. Okay, and you can change these settings. I normally tend to keep them as standard, but what we've got here, if you like, the lines are made up using these settings. Okay, so the MACD line, which is the red line, is the difference between the fast moving average and the slow moving average. Okay, so the difference between those two creates that line. The MACD signal line, the blue line, is a 9-period exponential moving average, EMA, of the red line. I know that sounds a bit strange, but it's an average of an average. The blue line is a moving average of the red line. And the red line is the difference between two moving averages. If you can get your head around that, hopefully it will make sense. The histogram displays the difference between the MACD line and the signal line. So it's just simply a graphical description of this gap. Hopefully that makes sense. The bigger the gap, the bigger the histogram. Okay. The zero line in the middle is the center line. And that's where these two lines will cross. So that generates your signal normally. So it just again graphically displays it all for you. Hopefully that helps. That gives you a bit of an idea about the signals. I never change the 12, 26 and 9, but if you want to play around and experiment, try and slow signals down or speed them up, feel free. But 12, 26 and 9 is just standard. A lot of people will just use that as it is. So there we go. And we've got a basic strategy in place. Now, there's probably a few ways you can use MACD to trade, but we're just simply using the crossing. So when trading with MACD, you always, again, I'm going to mention it once more, always want to be identifying your trend and the support and resistance levels. And once you've done that, and an opportunity has come up to trigger a trade, my advice at this stage is to always be using a protective stop loss. So, safety first. So once you've got your trading opportunity and you're comfortable to enter into a trade, you'll do well to place a protective stop loss either just below most recent support or above most recent resistance. So let's take a little look and see if we can do buy signal here. I might actually just see if we can get a live one. Let's go into, we know that this trend is down, okay, on a daily chart. So I'm going to move now into a 30-minute chart to see if I can get some signals. Okay, so I'm just going to remove these averages because I don't really want them on the chart at the moment. So I'm looking for periods where the red moving average line crossed below the blue MACD signal line. Okay, so there's one right there. Another one up here. In fact, there was one right there. Right about there. So at that point there, we crossed, as you can see by the histogram coming below the center line or the red line crossing below the blue line. That was the point to get into the trade. So on the close of that candle, you would get into your trade. So let's say it was around about, well, let's say you got in a bit late, about there. Okay? Bit messy with the lines, I know, but if you can see through them, you'd have got in here and you're looking to sell for it to go down. Crude lines, gotta love them. Okay, so where are you going to put a protective stop loss? Well, normally you'd put your protective stop loss above the most recent high, which would have been there. Okay, so you would have got in at 91.18, and in this particular case, you have to put a pretty wide stop loss here at 93.30. So what's that? 100 and 200 points or so, 220 points. So your goal really with these particular types of trades is to get a 2-to-1 reward to risk ratio. So if you are risking, in this particular case, in this example, 220 points, you want to be looking for 440 points as a return. Now you're in a falling market, so it's possible you can get that. When you follow the trend, it's much easier to get that. But 400 odd points from here is going to be, what, 8,700 on the DAX? So if you've been following the DAX, you'll know it's possible. But it's a pretty big move to go for. But it gives you an idea at least. So so that was a trading opportunity right there. We'll go back maybe a little bit further, see if there's another one. There was a cross there. So let's say we would have got in here. Put our stop loss above that little swing there. Zoom in just to show that in a bit more detail. Let's just minimize this a little bit. So we had the cross about here. We were waiting for that candle to close. Let's say we would have got in on this one, but maybe got in late and didn't get in till about there. 94.70. We put our stop loss 96.30. So what's that? 160 points. So you're looking for 320 points of return to get a 2-to-1 risk reward ratio. 320 points, would have caught that quite comfortably. And not really actually been in drawdown at all. Not once did really the price get above into this kind of zone where you were in trouble. So really, really profitable trade, very, very simple. You're just simply following the trend and you're trading the signal. Okay, so that one was a lot easier. This current one that we were trading was probably still working on heading lower. We'll see. You go and follow it, see how it gets out. And the last example, let's just take a look at the final one. Where's another cross? Let's go with that one there. Let's zoom in to the histogram. There we go. It was about there. So let's say it was on the close of that candle there. You put your protective stop loss above that one there. And you can already see that you would have hit that quite comfortably, but you've risked 137 points, so double that to 274. Yeah, I mean, easily. You'd have got 4 to 1 on your money there. Pound a point, 500 quid. Not bad for a day's work or two. So it can be really simple, the MACD, as you can see yourself. It's very straightforward, but the key thing is only follow the direction of the trend and use the daily chart or the 4-hour chart or something bigger to work that trend out, and then zoom into a lower time frame to find where your crosses are. That's how you'll get in. Set your protective stop losses and go for a 2-to-1 reward to risk ratio. You always want that. Because put it this way, if you're doing a 2-to-1 reward to risk ratio, and you can go and run the statistics on this, but I'm going to make a comment that a trader can run at a 40% win rate and still be profitable. In fact, a trader can run at 35% win rate and still be profitable if they stick to that rule solidly. So reward versus risk. We've laboured on the point of trading in the direction of the trend. And the final point is just the reward versus risk. You want to be making sure that you're setting the amount of risk on your account. No trade really should be risking more than, say, 2% of an account. If you're risking more than that, you're probably stretching too far, or you're just very aggressive. But risk management is key. If you want to keep your account going, you can blow your account out easily with a high volatility market like the DAX. With slippage and other things, you can really get yourself into trouble. So once you've set a protective stop loss, you know how much you're risking. You can double that or triple that or whatever you want to do to get your targets. And you always want to be earning more than you're losing. Your winners should earn you more than your losers. For that reason, you don't always have to be right more than you're wrong. Okay, and the final point that we're going to talk about today, the final points we're going to talk about will be a signal which I really, really enjoy trading, which is called MACD Divergence, which is useful in all kinds of oscillators, stochastics, RSI, all of this sort of stuff can have divergence. And they're great signals to trade. One of the most profitable and effective trading strategies that exists on all trading oscillators, in my opinion. And it features heavily in my personal trading and in live trading sessions that we do on the website, and our premium services and our educational webinars and all of that. We'll utilize this a lot. Okay, so the basic idea of the divergence is that sometimes you'll get a signal to sell. Okay, and I'm trying to find an example actually. I might already have one ready. There we go. Sometimes you'll get a signal. So I'm looking at oil at the moment, and oil's been bearish, pretty clearly bearish for a long time now. So you're looking for selling signals. Now oil, as you can see here, we've had this kind of rally up to support, which was a assume for now it was support. We had a crossing of the MACD down here, so we would have sold that wherever the signal may have happened. We would have put our stop loss above this high, and it started coming down. Would have done quite well, may have even hit our target, but let's assume it didn't. Came back up, stopped us out, and it created a higher, another high. But what you'll notice is that whilst we made a higher high on price, the indicator made a lower high. And that's called divergence. And in this particular case, that's called negative divergence, which is a bearish signal. And if you get negative divergence in a bearish market, brilliant. Happy days. I'd be putting maximum 2% on the account, probably adding to the position, and I'd just keep going with it. Because negative divergence against resistance in a bearish market is about as brilliant a high probability trading setup as you can get, in my opinion. And in this particular case, it worked out really well. We would have maybe, let's say we got in at, what would that be, about 37, put our stop loss above here, go for 2 to 1, maybe 3 to 1, and down it goes. Happy days. Excellent opportunity to sell. I think it works the same way the other way around as well. So let's just see if I've got another example to show you. Okay, so this is an example of gold. And you'll notice again here, you had recently we've been experiencing a rally on gold, as we've been experiencing a bit of risk aversion. And we had the first signal to buy gold down here, which let's say we took, and we put our stop loss under the low. It went up a bit, happy days, but we didn't take the profit, so we left it on, but it hit our stop loss, and it created a lower low on price. Now we created a lower low on price, but the oscillator created a higher low, so we created positive divergence, and it's the complete opposite of the previous signal. Positive divergence on MACD in a bullish market against, let's assume this was resistance, support should I say, is a brilliant opportunity to trade. Price rallied by $40, and it worked out to be a massive trade. Really, really profitable. So they're the best high probability signals, and looking out for those is where you're going to do really well. And of course, we've got signals and indicators and things which we can share with you in our live trading rooms. So if you want to come and join us, we'll be able to share some of those sorts of signals with you as well. Really boost the trading account if you can take advantage of them. And that pretty much brings us to the end, guys. So thanks for watching the video. I hope that's kind of explained a few things for you. And we'll be back again with another video where we're going to be taking a look at the RSI and the stochastics oscillators as well. Best of luck with your trading, and we'll hopefully see you in the live webinars and the live trading room. Take care.